Test, test.
Hey, Charlie.
Hey, Cal, can you hear me?
Yeah. Can you hear me?
I cannot hear you, so let me see.
Uh-oh.
Cal, can you hear me? I can see you, but I cannot hear you. Let's see what's.
Well, how about now? No? Let's see.
Here, Cal, say something.
I am.
Nothing. I'm turned up all the way. I'm not in my normal office, so I'm trying to figure out if it's something on my end.
Let's see.
Oh, wait, I think I can hear you now, Cal.
Oh, can you?
Yeah, I got you now.
Okay, good.
Just had to switch it around a little bit here.
All right. As long as you can hear me, that's cool.
Yeah, there we go. Perfect. Okay.
Good, good.
Yeah, we're doing some renovations in our office, so I'm in a different, down in the basement.
Down in the basement.
We're probably where I belong, honestly, for being real. How are you?
I'm good, man. How are you doing?
Good.
Yeah, good.
Did you have a good holiday weekend?
You know, every weekend's a holiday for me, so
So they all kind of run together,
they do.
huh? Nothing wrong with that.
Had a big limb fall out of a tree in my front yard, so I spent part of my holiday weekend with a chainsaw in my hand.
There's nothing wrong with that, man. That's as
Yeah,
long as
well,
nothing got torn up.
if it were, like an oak or something, it would be one thing, but it is a white pine and the wood's no good. You can't do anything with it.
Oh, okay.
If I'd been able to get some firewood out of it, I'd been okay, but can't burn that pine.
Really? Why is that?
It's got too much sap. It'll fill your chimney up with creosote, catch your house on fire.
Oh, geez. Okay. Can you burn it outside or you just got to haul it
Yeah.
off?
Yeah, I've
Burn
got a
outside.
burn pit.
Yeah.
Let's see. We got people trying to get in. Are you letting people in?
I don't think so. I'm
Here,
not
I'll do
seeing
it.
anything.
We got 7 folk here.
Hey, everybody, if you can hear us, we're going to get started in just a few minutes. Kind of let everybody get joined in, make sure everybody can chat and do what we need to do here. If you just joined, we're going to get started in just a couple of minutes. Make sure you're muted for now, and then we'll kind of stop for questions and things as we're going along.
Good afternoon.
Good afternoon. We're right at 12. For those that haven't joined one of my webinars yet, I typically will run, we won't take the full time. So we'll give a couple minutes for people to join, and then we'll have some time to talk kind of as we're going at the end. So we're not in a big rush. We'll get started here in just a minute or two. All right, Cal, what do you think? We get started?
Yeah, let's do it.
All right.
Just
Thanks
as you
everybody
say
for
that, we got
joining.
one new person who just clicked in, so there you go.
Okay, perfect. Well, we'll get rolling. Thanks everybody for joining. I'm going to make sure everybody's able to. We've got a chat feature on here. So if you have questions kind of as we're going, feel free to put those in the chat. And then also, I'll stop, and kind of in between every few slides. My presentation won't take the full time. But we'll, like I said, we'll stop and it'll be informal. I want everybody to be able to ask questions, and then you can ask questions on specific slides, and then we should have some time at the end to kind of, if you got some more stuff that we didn't talk about, anything banking in general, then we'll get rolling. So I'm Charlie Ogden. I work in commercial banking. I've been partnering with Score for since mid 2020, about 5 years now, and I teach these monthly classes on banking, cash flow, where to get lending and things like that. And I moved to Nashville in 2013. I live in Mount Juliet with my wife and two little girls. And I've been in banking since about then. I started on the personal side, worked for a regional bank, and have kind of worked my way up, you could say, from kind of personal to small business to kind of more larger, small to medium sized commercial businesses now. And I do a lot of the lending. So with that said, I've seen a lot of different things. Hopefully, I've got a decent perspective on anything from the personal side of the house all the way to the business. So hopefully, I can kind of give you some good points and point you in the right direction on some of this stuff. So today we're going to be talking about lending. This is what I do every day, and so we'll get started and kind of go through here. And forgive me, I'm kind of looking back and forth. I was telling Cal we're doing some renovations at our office in Nashville, and so I'm down in the basement, so I'm not in my normal setup. So I'm kind of moving all over the place here, but hopefully everybody can see my screen and we'll just get rolling here. Um, so I like to put this infographic kind of up first because really what we're going to be talking through is from left to right, kind of what stage is your business and what's appropriate to kind of from an expectation standpoint of where you'll be able to get lending sources. And it does change depending on whether you're either just getting started, maybe it's an idea in your head, all the way up to, the business is started, it's producing, your available options will change and what's appropriate will change. And we'll talk through this. With being with Score, most of our folks are going to be kind of on the left side here with either in development, startup phase, and that's where we'll spend the bulk of our time. So we're going to talk through various funding sources today. We're going to go from, startup financing, bootstrapping, crowdfunding, to all the way to loans or lines of credit that you would see at traditional banking, and then investors and kind of everything in between. So we'll start with bootstrapping. And like I said, this is going to be on the far left. So say this is a business that probably hasn't got started yet, or maybe as early as in its infancy. Bootstrapping is what you'll see, a lot of folks doing like on Shark Tank type stuff, where you're essentially self-funding is what it is. You're not taking on any investors, and you're just basically using what we'll see a lot of people do is if you have equity in a home, or savings, and it's something where you need a small piece of equipment, or maybe you need to lease out a space, and you don't want to necessarily take on investors, or maybe you're too early to really get bank financing, you can bootstrap it. And there's benefits and drawbacks to bootstrapping. Um, the benefits kind of on the left side here is your flexible timelines. If you don't owe anybody any money, if you don't have to make a loan payment, then you can kind of build this thing as fast or as slow as you want. Especially if it's something you're doing on the side, like you maybe you have a W-2 job, or you're working and this is something you're just kind of getting rolling. If you don't have any investors or anybody to pay back, you can kind of just do it as it makes sense for you. And more ability to pivot. I like that one, because if something changes, if it's something you're working on, maybe it doesn't make sense, it's nice to be able to pivot if you haven't taken out a loan, because that can make it harder, because you're like, all right, I need to pay back this loan every month. And if you haven't done that, if you just bootstrap, then you got a lot of flexibility there, and more financial discipline. If you're paying for it all yourself, you really kind of figure out, all right, I need to budget, I need to do things a certain way. That can be helpful. Some of the drawbacks are, typically fewer resources than if you got a loan or got an investor. The growth can be slower, and you may not be able to survive in a competitive market. And this one's important, especially if it's a product that you're coming up with, or maybe you're tweaking an existing product and there's other people that may be doing the same thing. Bootstrapping might not be a good fit, because if it's all about, I need to get this thing out there as quickly as possible before somebody else does it, then you may need to take on an investor to help you grow it more rapidly. So, just some of the benefits and drawbacks there. Another thing we see very early on is friends and family helping out with loans, or even just giving the money. The advantages are obvious. That most time family is going to trust you. They're not going to give you some crazy, if it is a loan, they're not going to give you some crazy interest rate usually. A lot of times they won't even ask for any ownership. And we'll talk about the differences between like a loan versus what's called equity, or taking on investors. A lot of times they'll just give it to you at a very kind rate, and very kind terms. Um, and they'll stick with you when you go bad. The disadvantages are the one that I always want to kind of highlight is, and it's really that bottom one, is risk destroying personal relationships. So just know that if you take money from a family member, just always be very clear on the front end what the terms are. If it is they're just gifting the money, make sure that they know that and you know that, and it's been discussed, and it's not something where you think it's a gift and they don't, or vice versa. Because that's where I've seen some issues. Or if it's something where you had in your mind, say your uncle's giving you some money, and you are giving you a loan, and you had in your mind a certain terms to pay back. Oh, I'm paying him back over the next 10 years. It's $100 a month or whatever. And he was thinking it was going to be paid back in a year, and it's $1,200 a month or whatever. Those are very different, and that can be damaging to a relationship. So I always tell people, this bottom left, use a promissory note. And that's basically anytime you get a loan, whether it's to buy a house or a car or anything, you sign a promissory note. And that's just the nuts and bolts of the loan, really, of this is how much I'm paying back. This is the rate. This is how frequently I'm making payments. And that way, on the front end, it removes any sort of errors, or any sort of, I thought one thing, you thought another. That way we're clear. We know what it is. We both signed it. And some people feel like, oh, I'm not going to do that. It's family, but it protects everybody, and it clears the air. That way, you know what it is. And it's not something where if somebody comes back and says something different, it's like, this is what we signed and this is why we signed it. So I'll always recommend, I think working with family is great, but use a promissory note or some sort of agreement, and you can find them online. So you don't risk those relationships, and it's something where everybody knows what's at stake. A big one that we've seen growing, gosh, for the past 10 years at least, is crowdfunding. And a lot of people have heard of Kickstarter. Kickstarter is a lot more product driven from what I've seen, where essentially you say you're coming up with a new cool type of like bike that can do something awesome. And these people can essentially give you small amounts of money. It can be $5, it can be hundreds of dollars. And they get, maybe that puts them in the running for when the bike comes out, they're first in line to get it, or they get some kind of cool decal or some kind of special custom bike that's different. So that's kind of how Kickstarter works. GoFundMe, everybody's heard of this. It typically is another way to gift money, and people can do it. It helps because it allows a bunch of people to give a small amount, and so it's less difficult for them, but it adds up quite well for you, as long as you can get people to donate. And those first two are nice, especially if you have if your company is something that where you can grow a social media presence really well, if that's a gift that you have, um, linking that to your Kickstarter, your GoFundMe, and there's other ones, but these two are pretty prevalent. But if you can kind of leverage your social media to drive, interest to that, then these can be great. They take fees, so make sure you're looking at them. They're not free. But when you sign up for them, there'll be an agreement that they may take a percentage of whatever you get. So just know that you are paying for it. And then peer-to-peer lending is a little bit different. It kind of functions similarly, but it's basically where you can go onto these, like Lending Club's one, and you'll have people on there and they want to do loans, but they may want to do instead of a big, $1 million loan, they want to do a $5,000 loan. The rates are usually a little bit higher, but if it's something where you need just a little bit, you can work with folks and they'll give their money, they'll lend their money to you through this online company, and at like I said, a higher rate, but allows you to get loans earlier on than you would if you don't quite qualify for bank financing yet. Um, Once again, there's fees and other things to just keep in mind on a lot of the online stuff. And I'll say this again, but be careful with anything online. Just make sure you're reading through it. Maybe read some reviews. Just ask around, because some of this stuff is not on the up and up. So I just don't want you to get involved with something that could be predatory, or could be something where it's almost like a cash advance or payday loan, because it can be devastating, especially if there's hidden rates and fees and things. So just be really careful about not all money's created equal, I guess is what I'll say. So make sure that you're kind of reading through that before you just sign up for something that could end up hurting you, in the long term. All right, so we're going to move over to investors. Actually, we can take a quick break. Anybody have any questions at this point? All right, we'll keep rolling. Like I said, if you have questions, feel free to speak up, or you can put one in the chat. So we're going to talk about investors for a little bit. So I could get kind of referencing back to Shark Tank. Anybody that's seen that, that's essentially what you're seeing as investors. Angel investors, typically, all that means is they're investing early on. Companies are typically at their riskiest early on because they haven't proven it, especially if they haven't created the product yet or the service. So that's why they're called angel investors. But all investors do want a piece of the business, vast majority of the time. So what that means is when you start a company, you own 100% of it. If it's just you, if it's you and a spouse, then it may be 50-50, or you and a partner. But just say it's just you, well, you own 100%. And if you, talk to an investor and they want to give you some money, say they want to give you $50,000, or they're going to want a piece of your business, and now you're partners at this point, whether they get 5% or 50%, you're partners with them, and there's an expectation usually from them that they get their money back at some point, and plus some, because they're taking a risk on you early on. So as you can see from this slide, the pros are it doesn't need to be repaid. So it's not a loan usually. They're giving that money to the business, but instead of getting an interest payment every month, they're getting a piece of the business in the hopes that eventually they're going to get some sort of distribution. Or if you sell the business in a few years, and right now it's worth $100,000 and you sell it for $1 million, well, their portion, goes up proportionally. So they get a bigger piece of that. Another good benefit is exposure. And I like this one because I think that it makes a lot of sense. This one and kind of the valuable networking connections, I think, runs together, because it just is like not all money is created equally. Not all investors are created equally. So if you can find an investor that maybe has done this type of business before, or has a lot of connections, and it's not just giving you money, they're also can connect you to other people. They can kind of help you avoid some mistakes and things. Then that's worth more than just the money itself a lot of times. So I would say that as well. If you're looking for an investor, kind of be cautious of who you invest with, because a lot of times you can get more than just the money, because they want your business to succeed as well, because they get that bigger return. Business expertise, that kind of goes along with that, and then opportunity to grow fast. We talked about that a little bit before, but yeah, if you can get an infusion of cash kind of early on, that helps you grow faster, especially if it's a competitive type situation. The cons we went through a little bit, but diluted equity, all that means is your equity is your ownership, just like in your house. When you start, you have 100% equity, 100% ownership in the business, and then as you dilute it or sell it off, you own less. And then eventually, if you own less than 51%, then you're not potentially cannot be the decision maker anymore. So you just want to be careful about giving that away because it's hard to get back that equity, especially if the company starts doing well. They're not going to want to let it go. So that's kind of the biggest difference between a loan and a giving up equity. Management fees, we talked about loss control, mismatched interest. This is where you want to, again, be really cautious and thoughtful about who you bring on as an investor. Make sure that your goals are aligned. Because if it's something where for them it's an investment and they want their money back fast, 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 and that means, all right, I got to grow and do this. Otherwise, I'm getting pressure. Um, but if it's something where they understand kind of the long-term goal and it's something like, hey, this isn't gonna be profitable for a couple of years, but in years 5, 6, 7, or whatever it is, we can really see this. And it just make sure you're aligned. And for them, it's not just a get my money in so I can get it back out real fast and make more. So um, that's some of the back and forth. So I want to,
Charlie,
yeah.
do you see the question?
Let's see. Okay. Are there any good networking opportunities or meetings that you're aware of where prospects can meet angel investors? I'll talk about that in a minute. There are a few organizations. I don't know of any specific like networking events, but there's an organization called the Entrepreneur Center, or it's either Entrepreneur or Entrepreneurship Center in Nashville. If you just Google it, that's essentially what they do. So they're similar to Score, but the biggest difference is they help bring in investors. So people that you can kind of almost pitch to in a Shark Tank type way. Um, and they'll also help coach you in things. But that's the bit like Score doesn't, for the services that Score provides, they don't take any ownership in your business. This would help Entrepreneurship Center or Entrepreneur Center, whichever one it is. They'll partner you with someone that can potentially be an investor. So I would start them, and they want you to succeed. That's kind of their whole goal, so they can help you. They're hopefully not going to partner you with somebody that's trying to just get an investment, and move on. But
It's called the Entrepreneur Center, and
there you go.
you can sign up for a launch program and you'll get a mentor who will probably also be an angel investor, who will walk you through the process of trying to get your business launched. And there are a number of angel investors who hang out down there and provide that mentorship for aspiring entrepreneurs.
There you go. Perfect. Thank you, Kyle. Yeah. So, and they probably do have some sort of networking events and things where you can go meet people. So I think that'd be a great place to start. Um, any other questions while we're paused here? All right, we'll keep rolling. That was a great question. Thank you for asking that. So kind of as we're thinking through progressing from very early stage investors, crowdfunding type thing to kind of the next stage, that's where you'll see a lot of CDFI lending, and that's community development financial institutions. And so most cities have some sort of CDFI. I know Nashville has a few, Cookeville has a few, obviously Knoxville and the larger cities do. Um, what a CDFI is it's almost like a bridge between your startup, you haven't even really started the business, to maybe you've started, or maybe you've got the idea really worked through and you're ready to start, but you're not quite ready for like SBA and traditional bank lending. So what CDFIs do is a lot of them are nonprofit, and they'll help with you kind of getting started. Now the rates are going to be higher, and that's something to always remember when your business is still earlier on. It's in its riskier phases. The cost of money is usually going to be higher because it's riskier, and that's kind of how banks, that's how CDFIs, the SBA, everybody looks at it. And then as your business has been around, as it's performed, it's considered less risky. So the cost for you to get a lending is less from a rate perspective and fees and all that. So Pathway, if you're looking for a CDFI in Nashville or kind of the greater Nashville area, Pathway is a great one. It's called Pathway Lending, and that's essentially what they do is they will partner with you. They'll help you kind of work through your idea, but usually you want to have the bulk of your business plan and everything ready to go. But they'll say, okay, if you're wanting to start a restaurant, um, they do a ton of restaurant financing around town, and say you've got a little bit of money to put in, or you've got a home where you could kind of pull some of the equity out of there. They'll bring a part, you bring a part, and they can kind of help walk you through that in a way that get some financing, get you up and running, and then in a year or two, once you're stabilized, you can usually refinance that to a better rate through a traditional bank. So that's why I say they function as a bridge. They Some of them target like specific demographics. Like some of them will are more looking to lend towards women-owned businesses or veteran-owned or minority-owned businesses, or they're looking for lending in certain rural areas. Like if you're in, you're not in Davidson County, but you're in one of the outer markets, and you say, "Hey, this business is going to bring jobs for 5 people in my city," and it hits that zip code that they're looking for, then they're kind of pushed to do that. And so they have different mandates for grants and things they receive. So that's kind of how that works. And then they also, I know Pathway, and I think some of the other ones, but Pathway specifically, every couple of years, the federal government will pass out. A lot of this happened during COVID, but they'll get certain grants from the government. They're like to stimulate small business, and the federal government doesn't have the people, the boots on the ground to actually know where that money should go. So they'll distribute it out to companies like Pathway, and they'll say, okay, you set the parameters, but we want it to go to small businesses. And so what they did a couple of years ago is they said, all right, if you're a business that makes less than like 100,000 a year, and you've been around less than 2 years, we can get you low interest loans, and it was like 2%, like it was essentially nothing, up to $50,000. And these are all just kind of numbers, but generally that's what they do. And so they kind of function in those two roles of helping startups, but also distributing these different funds and things. And also they get grant money sometimes, and they'll work through ways. So I say all that to say, with Pathway, I'd go ahead, if that's something that sounds interesting, go ahead and just reach out to them. But also keep them on the radar. If whatever they're doing now may not be a good fit, they also are always announcing different things they're working on. So just check with them periodically, and see what they're doing. Any questions on CDFI specifically? Pathway is the one that I've worked with before, but I think there's a few others. So if you just search CDFI, they should pop up a few. But any specific questions on those? All right, keep rolling. Invoice factoring, I include this in here. It is a if you know what it is, then you're familiar. It's something that's it's for very specific types of businesses. And basically, if you imagine like say a contractor, for example, or anybody that has a lot of accounts receivable, and if you're not familiar, it won't apply if you're like a restaurant or somebody that gets paid immediately. But say you're somebody that maybe you produce a product, or you're a contractor where, say you're a plumber, and well, plumber's not a good example. Say electrical contractor that's doing new buildings, and you go in and you do you complete your task of putting in all the electrical wiring and everything else, and then you send in to be paid, and you may not get paid for 30 days. That's called accounts receivable. So that money's owed to you within 30 days. And but in the meantime, you still have to run your business. You still have to pay employees if you have them. You got to pay for supplies and all that stuff. Well, invoice factoring is where that comes in. Essentially, if you have if a majority of your business comes from that account receivable where you don't get paid immediately, you get paid on terms, you can sell your accounts receivable, and they'll basically go ahead and pay you. So say you're owed $50,000, they'll go ahead and pay you that 50,000 now, so you can use it to run your business. They'll charge you a fee, typically 1 to 5%, and then they'll go kind of collect the accounts receivable. So it's just a way for you to get paid faster if you need it. But it is a little bit more specific, and so it doesn't fit for everybody. I'm happy to talk more about this if anybody has questions, but it is kind of a niche thing that doesn't apply to a lot of people. All right, so we're kind of moving a little bit left to right more into established businesses. So say for the next few examples, the business has been started, or well, let's just say the business has been started and you're looking to get an actual like business loan from either the SBA or a bank, and you're not looking at a CDFI. What do banks look at? What does SBA look at? There's a few things we look at, and they're kind of highlighted here. Credit is a big one, and on this we're looking at business credit. That business credit functions a little bit differently, and it reports differently. As your business grows, we're going to look, and I'm talking about we as banks, are going to look less at you personally and more at the business itself, because the business is ultimately repaying our loan, right? So your personal credit does have an impact. Like right now, if I'm looking at somebody and they want to buy a commercial building, we'll look at your personal credit, but if your personal credit isn't great, it's not as big of a deal as long as the business itself can support that monthly payment of what that new loan is going to be. Now, if you've got a bunch of bankruptcies or a bunch of stuff that is showing that you've defaulted on commercial loans before, that can hurt you. But if it's something where the business scores or your personal score is not great, but the business is cash flowing really well and you're doing all these other things, then it's not a big deal for us. Now, I will say that when you're first getting started, it is a big deal because your business won't have the history usually to show that it can cash flow. So it kind of shifts when you first get started and you say you go get a business credit card and you want to get a loan to buy a work truck under the business. They're going to look heavily on your personal credit, like I said, because you don't have the business established as long. So just know that it can be a little bit of a kind of a moving sliding scale there. And then as you've been around, it becomes less important. Just so know that. Collateral is a big one we look at. So, and that just basically means what is securing the loan. So whether it's you're buying a building, or you're buying a piece of equipment or a vehicle, or maybe you're buying some computers, that's what's considered the collateral for the loan. Collateralized loans are a lot easier usually to get done than what we call unsecured lending. So if you wanted just a line of credit that's not secured by anything, that's a little bit harder to get. And that either your credit has to be better, the business has to cash flow well, versus equipment loans and things like that are a little easier to get because you've got that collateral behind it. In the event you defaulted on the loan, the bank can take that collateral and sell it. Is kind of the way that the thinking there. Um, Cash flow. Cash flow is pretty much the number one thing we look at when we're looking at any sort of lending request. And basically, that's at the end of the day, does the amount of money you bring in minus your expenses. So if you've been running a business or you've started kind of talking through that process, you'll have your income statement or your P&L or profit and loss. It's all the same thing. And you look at your revenue as the top number, and then you kind of all your expenses come out, and that money left over at the end, is there enough? And we can add back a few things, but generally speaking, is there enough to add in a new monthly loan payment um, for whatever you're trying to buy? And if not, then we may need to figure something else out or kind of work through it. But as long as there's enough left over, then we can usually kind of that gets us to the next step. Time in business is a big one. That kind of goes with some of the stuff we've been talking about. Typically, we want you to be 2 years in business for us to have 2 years of historical numbers to look at. Debt load's a big one. Same thing if you've ever bought a house, they're going to look at how much what's called your debt to income ratio. We look at something similar, but more on the business side. And then industry is a big one. Industry is one that you'll see really banks start to differentiate themselves on the commercial and business side. Some banks, for instance, don't really want to work with contractors because there's bonding and things that can cause lien issues. Some banks don't like restaurants. Some banks don't like certain things. So that's something I would just say if you're working with a bank now, just ask them. If you haven't done a loan with them before, like, hey, this is the industry I'm in. I'm looking to start a business, or I've started a business. Is this something you guys lend in? And if not, then you're going to want to start looking at another bank if you anticipate needing lending, in the future, because like I said, this is where not all banks are created equal. All banks will have checking accounts and credit cards and all that kind of stuff. But as far as lending, that's where banks will just they'll have picked different avenues that they want to go in and that they want to be aggressive in. So, any questions on this slide while we're looking at it? All right. All right, so we're going to go through the SBA, and then we'll kind of wrap up here in a minute with commercial lending and what we call conventional bank loans. So SBA, if you're not familiar, it's a government agency. It's built to basically support entrepreneurs to support small business. The SBA itself doesn't make loans. They use partner banks and partner lending institutions to make the loans themselves. The SBA provides the guarantee. So typically what happens is banks that have worked with the SBA for a while, they'll get what's sort of a priority status where they actually don't have to talk to the SBA. The SBA has said, all right, the bank, you understand our lending guidelines, so you're good. You can make the SBA loans and we'll provide the guarantee. And that just allows banks to do loans that they wouldn't normally do. Like say it is for a restaurant. And because our bank, just as an aside, we don't do a lot of like restaurant loans, but we will do loan on the conventional side, which is what I do. But we will do loans to the SBA for restaurants and things like that. So that's another thing to kind of circle back to talking to your bank. Maybe they don't do it on the conventional side, whatever your industry is, but say, hey, does your SBA group do that? And usually they'll have their own SBA lender that's all they do, because there's a whole different side of regulations and things that they have to work through. So usually they have a specialist that will just do that. And can kind of work through that. But the SBA, once again, is more of a bridge as well. Kind of like what we said with CDFIs. typically meant to be in an SBA loan forever. It's something where either maybe you're buying an existing business and you need an SBA loan to buy that business, or you're starting a business. The rates are going to be higher, the loan rates. There's going to be more fees because it is more risky. But it's something where usually you have that for a few years and then you can refinance that to a true conventional bank loan, and the rates are better. And then you've got the relationship with the bank at that point, and then you usually don't need the SBA again. The only times we'll see like a well-established business need an SBA loan is if they're making a huge jump. Like say they've leased a space for 5 or 6 years, they've been around, been doing well, and they want to buy or build a big building or buy a building, and it's just too much of a jump. Like their cash flow doesn't quite support it. Sometimes we'll use the SBA there because the SBA can use projections, and not to get too much in the weeds. We could talk more about that if you're interested, but the SBA loan can kind of fill that gap. But generally speaking, the SBA is meant to be temporary. It's just something to get you over the hump, get you going to where you can kind of work with banks, because banks are the least risky, but with that benefit, you get the best rates. So a little bit about what we call SBA 7A loans, which the majority of what we're going to be talking through with SCORE is loan amounts, as you can see, 50,000 to 5 million. Interest rates are fixed for 3, 5, 7, or 10 years. As you see, cash flow, something we talked about, that's kind of the number one thing we look at. They need it to be at what's called a 1.15 times, meaning for every dollar that you're paying out for all your expenses, for your loans, and the new loan you're potentially looking at, you need to be bringing in $1.15. And that little 15 cents is your buffer for any downturns and things like that. But that's kind of what they look at. And then projections, as we said, so you can project out what you think you're going to do with the loan, like once you move into the new space or once you acquire the business, which is something that's kind of unique to the SBA. 7A loans don't require necessarily collateral. You can buy a business and say the business doesn't have any. Say you're buying like some kind of consulting business. Well, you may not have any collateral there if they don't own the building or own a bunch of vehicles or things like that. So that's another good reason to look at the SBA. And you don't need to be an expert on this. Your banker will know all this stuff. And if they don't, you should probably talk to somebody else. But just ask them these questions. But you kind of having some of this knowledge will be helpful. And then we can kind of go through the rest of the stuff. But the other big thing about the SBA is the story. Because a lot of times people that are using SBA loans maybe have not been in the business before, or they're buying an existing business, and so they've got the numbers of the business, but they don't, they're still like, well, how are you qualified to run the business? Is essentially what the SBA is going to want to know. And so that's why you really want to have this other stuff of your story. Is very important to the SBA, like industry experience. Maybe you haven't run this type of business before, but you've had a leadership role in your business, or maybe if you're buying an existing business, you're keeping a key employee and you're having them sign a contract or something that kind of helps them say, okay, you're going to be successful running this business because of X. And so that's something to kind of look at. And just, SCORE is really good at helping with this stuff, but putting your story in writing, business plan, financial data, all that good stuff. And then make an appointment with the bank. And like I said before, ask for the banker that handles the SBA loans, because it is a specialty, and there's some differences there than just regular bank lending. And so kind of wrapping up a little bit, this is a different version of what we looked at before, but it kind of sums it up well. So as you see, startup, this is where you're going to have access to things. Personal savings is typically in startup. Family and friends, we talked about crowdfunding. Loan marketplace, online lenders. I still want to put that caveat out there. Just be careful when you're looking at online lenders. As I said, there can be some stuff that sounds better than it is, and it can be predatory and can end up hurting you. And then CDFIs and nonprofit lenders. But like I said, you kind of see that stark differentiation right there. Is once you're past that early stage, which, like I said, typically 2 years, that's when banks and credit unions will step in. And you've got that historical cash flow at that point for us to look at. And that's kind of it, guys. We've got plenty of time to talk through any specific questions about any of this stuff, or if you want me to go back to any slides, happy to do it. So y'all let me know.
I have a question. The accounts receivable that you were talking about where they sell they buy them from you. What was that called?
Factoring.
Factoring. Okay.
Yeah.
Thank you.
Yep. If anybody has any just specific questions about their business, it doesn't have to be lending related. Happy to talk through that as well. And then I'll, like I said, I'll send this out to, I think Alicia sends these out. So she'll send this out with all this. And if you end up having questions too afterwards, we can circle back. But okay, let's see here. Matthew, do I take appointments for pitches? I'm trying to think of, what do you mean? Oh, like pitching your business? Is that, Matthew, and you can come off mute if you want. Now, is that what you're asking about? Okay, pitching my business. I will tell you, I may not be the best resource for that just because I don't do a lot of that type of lending anymore, with like startup lending, if that's what you're asking. I'm happy to talk through it with you, but I think the Entrepreneurship Center or Entrepreneur Center would be maybe a good fit for that too, because I know that's really what they focus on. Oh, he says he's locked here. I don't know. I don't know why it says that. It says you have permission to talk on here, but either way, yeah, I could talk through with it, but I wouldn't know. I don't think I would have maybe be the best resource from like what financing would be best other than SBA. But yeah, I mean, I'm happy to talk to you. Nobody's asked me that before. That's a good question.
If, if you have a mentor through SCORE, if you don't have a mentor through SCORE, it's really easy to get one. And a SCORE mentor can help you with your pitch deck.
Thanks, Cal. And then I'll also, the other thing I do for SCORE other than these monthly classes is they'll call me sometimes if as they're developing the business plan or they're getting ready for a loan, if they want kind of the bank perspective, I can come in and we can have a meeting too to talk through like your specific business, what it is, and then what the bank would be looking at when they look at that. And I can kind of serve as that, person kind of filling in that gap. So I'm happy to do that as well.
I have another question.
Yeah.
Okay, so we're wanting to know if you had any sources of that fact that would help with funding for a business it's going from nonprofit basically for 17 years. We're switching to LLC, and it's disability education is basically the industry, and
Okay.
looking for startup money.
Okay, so what are you needing? Like, what's the money for?
It would be for paying office supplies. It would be technology that our employees would need, supplies for the programs that we are going to be presenting to new clients, things like that.
Okay. I would probably say Pathway, I think, is a good one to start. Just anytime I hear anything that's nonprofit, even nonprofit related or historically was nonprofit, they do a lot of that type of stuff. And I think that's one of their like demographics they go after is, like I said, some of them do veteran-owned businesses and things. That's something that I've seen them do a lot of. So I think you can just reach out to them directly through their website, and they have specific folks over there that are relationship managers, and they can give you a call and talk through it. But I think that would be a good one, because you're not new, you've been around for a while, obviously. So there's a cool story there. I think they could be a good fit.
Yeah. All right. Well, thank you so much.
Sure. Anybody else? Well, I hope I didn't go too fast. I feel like sometimes I talk fast, but hopefully this was helpful. And like I said, if you have any questions, if you think of anything later, feel free to reach out. I think my contact info is, maybe it's not here, but it gets sent out when we send this out, so it'll have my email and everything. So if you have specific questions that you want to ask, kind of one off, feel free. And otherwise, appreciate everybody's time. Take care, y'all. Thank you.
See you, Charlie.
Thanks, Cal.